We need to talk about funding in 2025. I'm recording this at the end of 2024 for those of you who are founders that are going to be raising pre-seed or seed money in 2025. And this video is going to be more about a prediction, and let's see if it happens. You will keep coming back and subscribe to this channel and then follow along, and we'll track my predictions for 2025. But I want you to be as prepared as possible if you are that early stage founder and you plan on raising capital. It's the end of 2024, and there's no point in fundraising right now because a lot of people are on holidays, but now you can start getting ready. And if you're watching this in the future of this recording and you're watching it in 2025, the advice that I'm going to give you is going to be relevant through all of 2025. Plus, I will be doing regular updates to see if my predictions have come true. Before we continue, my name is Ed Kang, 7-time funded founder with 2 exits. That's just a fancy way of saying I failed a bunch of times, and that's to your benefit because I like to be very upfront and say that I've learned from my failures and use videos like this to help you avoid some of the catastrophic mistakes that I've made. Not to say you're not going to make mistakes, but I'm going to try to make your life a little easier because it's hard enough as it is, especially if you're an early stage founder trying to raise early stage funding. I'm also the Chief Strategy Officer for Startups.com. I'm part of the team that has raised over 750, almost $1 billion for other startups. I personally raised $100 million for my startups, other people's startups, as well as startups funds. So I've been around and I've watched the cycles happen. I was involved in .com 1.0 way back in the late 90s and the early 2000s, and I've seen the cycles come and go, and I've been pretty good about predicting it because I've gotten ready for every startup funding cycle. My last video that I did like this, I said it's not 2021 anymore, and we're just going to forget that. Sweep that all past. It's not 2024 anymore. By the time you're going to be watching this and becomes relevant, that has passed because we just went through a few years of nuclear winter when it comes to funding, and I believe we've hit the bottom, and now we're starting a new cycle that you're going to see get frothy over the next 4, 5, maybe 6 years. Here are the macroeconomic conditions that you need to consider and you need to look at. First, we just got through an election. President Trump got elected. Whether you agree or not, doesn't matter. The market has seen a swing, and people are starting to feel very positive. I was looking for that outcome, not based on policy, but based on economic psychology and everybody feeling good. Then we're going to see another rate cut. That's what we need to have. Then we need to see some other IPOs. We had a few IPOs in 2024, but they weren't spectacular, but it was the beginning. It was the bottom floor IPO. You're going to start to see other IPOs, especially those AI IPOs. When the AI IPOs start to happen, that's when things are going to get frothy. And frothy means there's going to be a lot of people with money on the side because it's cheap. They're going to take money out. They're going to be sitting on that cash, and they're going to be saying, you know what? What are the big bets that we can take? And they're going to look at the stock market, and they're going to see these IPOs and say, hey, wait a second. I can make the most money if I get in on the early stages. And you're going to see institutions start to get in that. They've already been getting into that. If you watch the types of checks that have been written for pre-seed and seed companies under $1 million, $1 million and lower, those have stayed steady. Why? Because founders and investors can work together, and the markets know that there's a cycle. So if an investor needs to invest in a startup, and that's going to be ready for the IPO in the next cycle, that's going to take 5 to 7 years. And guess what? At the bottom of the cycle, if you're looking at another 5 to 7 years for things to bounce, get really hot, where there's lots of money in the market, the stock markets have hit all new highs, you want to go IPO then, but you can't just do it overnight. You have to nurture that startup. So early stage bets have stayed steady, but most of them have been in AI. The early money has gone into AI because guess what? We're going to start to see those IPOs in the next few years, and then that's when the frothy conditions are going to occur. You need to pay attention to this very, very closely because you're going to see the investors, they're going to start following these trends. And now that AI has sucked all the oxygen out of the room, but now it's starting to monetize, there's an ROI. Founders are going to have an opportunity to reach investors who are going to look outside of the AI bubble because the money can't be made there anymore. Now, there are 2 things that I'm going to predict. It's not going to be a bell curve where the bell curve goes like this and all the money stays. It's going to be a well curve. And this is what I mean. There's going to be 2 sides to this curve. One side is going to be development, the other side, distribution. Once again, development, distribution. And as a founder, you need to be thinking where you fit. On the development side, that's where you fit. You've got a team, and you can do some crazy, wacky new innovation with technology that nobody has seen before. I am not counting out innovation. I don't believe that we have figured out innovation for AI as much as it can be. The potential has not been reached yet. The same reason it hasn't been reached with AR and VR and blockchain. A lot of promises in the beginning, but we learned from .com 1.0, it was all about put stuff on the internet and see if people can see it. Great, storage. Internet became storage. The websites, you go in, online brochures, everything happened like that, but there wasn't any business models, and then new things started to occur, such as social media, where it said now we can connect, we can communicate online, and then we went to ownership, Web 3.0, all that good stuff. Don't worry about that. But you saw this first wave of AI, VR, AR, but that was new technology. And I think if you can develop crazy technology, you can't be doing what other people are doing. I see a lot of founders, they're still contacting me right now and saying, I've got a new AI form builder. Well, that's not going to help. I've got a new AI app that tracks this. That's not different and innovative enough. You're going to have to push into crazy development technology. You're going to have that team of those data scientists, those AI guys, those crazy innovation builders, the disruptors that are thinking in such contrarian ways, but can also build it. It's not enough to think of an innovative idea. You have to be able to build it or bring a team together that can build it. And I think that's where the early stage money is going to go, where someone's going to say, I can build a widget. Look at my widget that looks completely different than everything out there. We figured out a new way to apply AI, figure out a new way to combine blockchain and AI. I don't know what it is, but you're going to fall into that category. And if you are building, let me warn you, if you're building something that's already out there, or you're building something where a big company thinks it's a good idea to build the same thing, you are not going to get funded. I see this and I eliminate it a mile away, because if I think to myself, guess what? Google's already building this, or guess what? Adobe's already building it. They think this is a good idea, or OpenAI. This is how I got burnt this past year. I invested into an AI project, and you know what happened? OpenAI, ChatGPT, came out with the very function that I was trying to build, and I couldn't build around it. And they came and ate my lunch and blew my investment out of the water. That is going to be a problem. I learned the lesson again, took my shot in AI. I'm not going to be doing that again. On the other side of this well curve is going to be distribution. On the flip side, let's say you are building something that has already been done before. There's another big player in the space, or it's very competitive. But if you can figure out a unique insight, a hack to the market to get better distribution, let's say you're building an LLM model, you're building an LLM skin or a wrapper to an LLM model that tracks some type of business vertical. Guess what? Everybody's doing that. OpenAI and other LLM companies are making it so easy for everybody to do that. So you're going to have so much competition out there that the investment dollars are not going to go into you. You might be able to make some money, but guess what? You're not standing apart. However, if you turn around and you say, we found a distribution model, let's say it's a closed social network. You're saying, all right, we're moving away from LinkedIn and Facebook, and we've created our own social media network where we have a hyper-focused and engaged audience. Same way that podcasting didn't hit its full promises, but it had a different method of distribution. If you're an Instagram influencer, TikTok influencer, the value of one follower, one subscriber has significantly diminished because of the way algorithms have changed. The For You page is completely different. But guess what? Podcasts have high engagement. This is where investors have been looking at podcasts, and they're still figuring out AI plus podcasts. You see the Notebook LLM models going out there. They want to know, because this is what happens. When you're listening to a podcast and you spend an hour or an hour and a half with Joe Rogan or whatever the big podcasts are out there, Call Her Daddy, I think that's the one. I'm not in touch with these things. Total boomer here. That's a different distribution model, because the parasocial relationship, when you spend 90 minutes with a podcaster, is much more engaging. They've proven it with dollars and cents than if you just got 1 million views on TikTok. It's not the same thing. But guess what? TikTok is coming in and they're trying to do other distribution where you can contextually buy things by just clicking on something, and you don't have to go to a website. You can just buy it right on TikTok. That's another method of distribution. So if you can say we've hacked some type of distribution method to make money, and look at the way that our model, our AI wrapper model, chatbot, whatever app, whatever it is selling like hotcakes and making more money than other people who might even have better technology. The developers out there that might be way smarter than you, but you figure out a hack to get better distribution. Let's say you're a creator, like what I'm investing in right now, in the creator economy. I'm very bullish on the creator economy. I believe believe it's going to be an anti-AI movement that boosts the creator economy. You're going to see the Etsy for the creator economy. Listen to these words, mark these words, and you come back to me in 2025 and you say, you are not, Ed, you were right, or you're totally wrong. I'd love to have that conversation. But you're going to see this anti-AI movement, and then people are going to say, I want to know that somebody has created this, and the more you do it in public, the more you record these videos, talking in videos that can't be recreated with AI, not yet anyway, then that's going to get better distribution. So once again, I'm predicting there's going to be a well curve. The money's either going to go into the craziest innovation, pushing the limits of innovation in terms of development. And there you need a team. You have to be building something that is so out of the box out there that investors go, my goodness, this is the future, take my money. Or distribution, you're getting so much traction in terms of distributing something that might not be unique, but you figured out an innovation, a new hack to get more traction, to sell more, get more eyeballs, more attention, because guess what? There's money and then there's attention, and those two are equally valuable because they combine and one brings to the other. You can get money and you can develop attention, but then also you can take attention and you can turn it into money, and that's what investors are going to look at. And I think investors are starting to get smart. In 2024, they start talking about the creator economy, distribution, and you see this happen all the time. Founders, especially second-time founders that exited because they developed something, they're more into distribution because they realized how hard it was, and you're going to find new ways to get product market fit. So there are my predictions right there. Check out this YouTube channel. If you're here, you're part of startups.com. Feel free to check us out. I appreciate all the support, but watch these other videos as I start to look through those predictions and I start to see, and I'm going to be doing experimentation myself, helping founders as their advisor, as well as my portfolio of ventures, and we'll see what happens. Stay tuned. Thanks for hanging out in this video. I'll see you in the next one.